Yes, so this is question number 2 from this topic of group accounts. And the question reads, 𝗓𝗂 Limited operate in fast moving goods subsector during the year which ended 31st of March 2023. 𝗓𝗂 Limited expanded its operation by acquiring controlling interest in 𝗓𝗂 and a significant influence over the activities of 𝗂𝗂 Limited. The following draft financial statements for the year which ended 31st March 2023 relate to the three companies. So first of all, we have the statement of profit or loss for the year which ended 31st of March 2023. Basically for the three companies, 𝗓𝗂, 𝗓𝗂, and 𝗂𝗂, we have the revenue, cost of sales, gross profit, distribution, admin expenses. We have the profit from operation, investment income, finance costs, profit before tax, income tax expense, and then profit for the year. Then from there, we have the statement of financial position as at 31st of March 2023, basically for the three companies here. First of all, we have the non-current asset, which include property, plant, and equipment. Then we have investments. We also have the current assets. So for the current assets, they include inventory, trade receivables, financial assets at fair value through profit and loss, cash at bank, and then we have the total current asset and the total asset. Then from there, we have the equity and liabilities. At the equity, we have ordinary share capital, share premium, retained profit, and then we have the total equity. At the non-current liabilities, we have 12.5% raw notes. Then we have the deferred tax. And then we have the current liabilities, which include trade payables, current tax. And then we have the total equity and liabilities, basically for the three companies here. And I think there is something which is missing here, because here we should have the total equity and liabilities for the parent, which should be equal to this one, plus non-current liabilities, plus current liabilities, this one, which should give us 5,500. And I think we can confirm, because this one should be the same with the total assets. Yes, the total assets, you can see they are 55. So mean that that figure is okay. So then from there, we have some additional information here. Number one, we are told that on 1st July 2022, 𝗓𝗂 Limited acquired 80% ordinary shareholding in 𝗓𝗂 for a cash consideration of 1,100 million. The fair value of the net assets of the assets and liabilities of 𝗓𝗂 Limited were equal to their carrying amount at the date of acquisition. Number two, the group policy is to measure non-controlling interest at their proportionate share of the net assets of the subsidiary at the date of acquisition. Number three, on 1st of January 2023, 𝗓𝗂 Limited acquired 40% ordinary shareholding in 𝗂𝗂 for a cash consideration of shillings 500 million. 500 million. And then we are told in note number 4, during the post-acquisition period, 𝗓𝗂 Limited sold goods to 𝗓𝗂 Limited for shillings 300 million. 𝗓𝗂 Limited reported a profit, a 20% profit margin on these sales, and then you're told half of these goods remained in the ending inventory of 𝗓𝗂 Limited at the end of the year, which ended 31st of March 2023. Number 5, we are told, included in the trade receivables of 𝗓𝗂 Limited was 80 million due to 𝗓𝗂. In the books of 𝗓𝗂, the amount due to 𝗓𝗂 was shown as shillings 60 million. Shillings 60 million, because 𝗓𝗂 Limited had remitted shillings 20 million, but 𝗓𝗂 Limited had not recorded the remittance. Number 7, impairment test carried out on 31st of March 2023 revealed that neither the goodwill on acquisition nor the investment in associates had been impaired. Number 8, we are told none of the group companies paid dividends during the year which ended 31st of March 2023. So what are we required to do? Part A, we are required to prepare the consolidated statement of profit or loss for the year which ended 31st of March 2023. Then from there, we are required to prepare the consolidated statement of financial position. So basically, this is a question for group accounts. And recall what we said is that anytime you come across such a question for group accounts, the first thing you need to do is basically to come up with a group structure so that you know the relationship between these three companies. Which company is the parent, which company is the subsidiary, which company is the associate, or do we even have a joint arrangement? So therefore, the first thing here is basically to come up with a group structure. And in this case, we're going to use the information which is provided to us here. So that is the first thing we are going to do. We come up with a group structure. So let's start with the workings here. Well, actually, we can say this will be a solution. And then we can start with the workings. We can start with the workings. So our first working is automatically to come up with a group structure. So working one here is we come up with the group structure. A group structure. So where do we get the information about the group structure? This information, we can get it from the addition information. There is some information which you're given there, specifically addition information about you're told. On 1st of July 2022, 𝗕𝗏 Limited acquired 80% ordinary shareholding in 𝗓𝗨. 𝗕𝗏 acquired 80%. So this one acquired 80% shareholding. It acquired 80% shareholding. 80% shareholding. Shareholding in this company here, which is called 𝗓𝗨. So we just copy this one, then we paste it here. Yes, and also in this case, we are given the date of acquisition here. So the date of acquisition, I think you're told is 1st July. I think I can just copy this one. We said whatever you can be able to copy. So okay, I've cut. I needed to copy that one. So we copy, not cut. Yes, so basically we said whatever you can be able to copy instead of to avoid a lot of typing is always advisable to do that. So therefore, that is the date when 𝗕𝗏 Limited acquired 80% shareholding in that company, which is called 𝗓𝗨. Then there is also another information we are given in. So first of all, I think we are going to skip and we move to note number 3. We're going to come back to note number 1. So in note number 3, we are told on 1st January 2023, 𝗕𝗏 Limited acquired 40% shareholding in the company which is called 𝗐𝗐. So this company here, 𝗕𝗏, we are told it acquired 40% shareholding in this company which is called 𝗐𝗐. So I think we can have 𝗐𝗐 here, or basically here. Yes, so in our case, we are told this company acquired 40% shareholding. 40% shareholding in 𝗐𝗐. And also, I think we are given the date of acquisition. We can have the date of acquisition here. So the date of acquisition as per note number 3 is 1st January 2023. So let's also copy this one. So when we bring it here, yes, 1st January 2023. 1st January 2023. So that is basically when 𝗕𝗏 Limited acquired 40% shareholding in what? In 𝗐𝗐. So therefore, this is our group structure. And therefore, from this group structure, we can make a conclusion and we say that this company, which is called 𝗕𝗏, this automatically will be our parent company. This will be the parent company. Whereas this company, which is called 𝗓𝗨, this one will be a subsidiary. And then this company, which is called 𝗐𝗐, this will be what? This will be an associate. This will be what? an associate. It is also important to check whether there is a company which was acquired during the current year. And actually, we can only be able to do that by checking when are we required to prepare the group accounts. We are required to prepare the group account for the year which ended 31st of March 2023. So therefore, this is the date when the current year was ending. So let's have that here. So the current year was ending on that on 31st of 31st of what? 31st of March. 31st of March of March 2023, and it basically means that this year here then started on 1st of April. It started on 1st of April 2022. 1st of April 2022. So having this now, we need to check, was there a company which was acquired during the current year? So you can see this one, it was acquired on 1st July. 1st July, I think I can just put that one as 1st July. 1st July of 2022. So I hope you can see 1st July 2022 is within the current financial year. Within the current financial year. And this is now how many months to the end of the year? We need to determine this how many months to the end of the year. So basically we have July, or actually from July, 1st July of 2022 to the end of 2022, that is up to 31st of December 2022. How many months do we have there? We have 6. From July, 1st July 2022 to 31st of December 2022, those are 6 months. And then you can see when the year was ending, 31st of March. 31st of March. This was supposed to be 31st of March. So meaning that from 1st January of 2023 to 31st of March, then we have 3 months. So therefore, this company here was acquired 9 months. 9 months to the end of the year. It was acquired 9 months to the end of what? Of the year. Now, this is very, very important, specifically whereby you are required to prepare the consolidated statement of profit or loss, because when taking into account the revenue and expenses of this subsidiary here, we will only take it for how many months? For 9 months. So we will take the revenue and expenses of the parent plus the revenue and expenses of the subsidiary, but the revenue and expenses of the subsidiary, we will only consider that for how many months? 9. Then we have this associate here. When was it acquired? It was acquired 1st January of 2023. Basically, 1st January 2023, this one should be 3 months to the end of the year. This one is 3 months to the end of the year. 3 months to the end of the year. And therefore, if you can be able to recall what we said yesterday, when preparing the group account, 1, we don't include the revenue and expenses of the associate or even that of the joint venture in the consolidated income statement. So what we only include in the consolidated income statement as far as the associate, as far as the joint arrangement is concerned, is the parent company share of the associate or joint venture profit after tax. So therefore, what we will do, we will take the profit after tax of this company basically for 3 months, and then we get the parent company share of that. So that is the only item you're going to include in our consolidated income statement. So therefore, this generally is our group structure here. This is therefore our group structure. And actually, this group structure is very, very important because this is the one which guides you in terms of how to do what? In terms of how to prepare the group accounts. And I think having that, we can now do the other workings which are required so that now we finally prepare our consolidated or our group account. So let's go back to note 1 here. And I think we are given information about acquisition of 𝗓𝗍 by 𝗕𝗏. We have the date of acquisition. We have the purchase consideration of 1,100. So this one will be used in the computation of goodwill. And then you're told the fair value of assets and liabilities of 𝗓𝗍 were equal to their carrying amount. What does this mean? It basically means that on the date of acquisition, 𝗓𝗍, which is the subsidiary, revalued the assets. But in this case, we are told that the fair value of assets and liabilities of 𝗓𝗍 were equal to the carrying amount. The fair value was equal to carrying amount. So if you're given such information, it basically means that despite now our subsidiary having revalued the asset, there was no revaluation gain or loss. And if you can be able to recall the question we did yesterday, we said anytime the subsidiary company revalue the assets and or for example, the fair value was found to be more than the carrying amount or the net book value, then we said that is a revaluation gain, which basically we said is one added to the group PP, and number two, it is also treated as a pre-acquisition revaluation reserve. So therefore, in this point number one here, what we will only consider is 1100 when computing the goodwill. Number two, we are told it is the group policy to measure non-controlling interest at the proportionate share of the net assets at the date of acquisition. Now, if you come across this particular information, this information is basically to guide you on the method you are going to use in computing goodwill. And actually, this is something we discussed, whereby we said that if you're given this information, that is the policy of the group to measure NCI at the proportionate share of the net asset, then in such a case, you compute the goodwill using something called the partial goodwill method. Partial goodwill method. But if, for example, in this case, we were told that it is a policy of the group to measure the non-controlling interest at the fair value, then in such a case, you compute the goodwill using the full goodwill method. So therefore, in this case, when computing the goodwill, you're going to compute the goodwill using the partial goodwill method because of this policy. Because we are told the policy of the group is to measure NCI at their proportionate share. Okay, so that is also to be used in the computation of goodwill. Number three, we are told on 1st January 2023, this is basically now 3 months to the end of the year because the year is ending 31st of March 2023. 𝗕𝗏 Limited acquired. Okay, I think in fact we have gone through these point. So I think what we will consider here is this purchase consideration, which was paid by the parent company in acquiring 40% shareholding in 𝗓𝗏. So we're going to use this one in computation of investment in associate. So let's move to the other point. So number 4, we are told during the post-acquisition period. So when we talk about the post-acquisition period, we are talking of the period after the acquisition. So during the post-acquisition period, 𝗕𝗏 Limited sold goods to 𝗖cie for shillings 300 million. So I think first of all, you have to recall that anytime you have sales between the parent and the subsidiary, because 𝗕𝗏 is the parent and then 𝗖cie is the subsidiary. Anytime you have sales between the parent and the subsidiary, then we refer to that as intra-group trading. Amount of intra-group trading or intra-group sales. And actually we said that such amount of intra-group trading or such amount of intra-group sales, this one, number one, it is supposed to be deducted from the group revenue and also the group cost of sales. So how much amount was that? 300 million. So this one, number one, we're going to rest this from the group revenue. From the group revenue, it will be deducted from the group revenue. Number two, we also rest this from the group cost of sales. From the group cost of sales. From the group cost of sales. So therefore, these are the two adjustments which are required as far as that amount of, or as far as that transaction is is concerned. So let's go back to the same point. We are told that 𝗕𝗏 Limited, in the same point number 4, we are told 𝗕𝗏 Limited reported a 20% gross profit margin on these sales. So, and then we are told half of these goods remained in the ending inventory of 𝗖cie Limited at the end of the year. Now, basically, this is something we came across in the other question we did yesterday. And what we said is that anytime we have sales between the parent and the subsidiary, and some of the goods remained unsold at the end of the year, automatically we have now the component of unrealized profit. So therefore, what we need to do here is we compute the unrealized profit, the URP, on inventory. And in this case, we said that this unrealized profit is always by the selling company, is always by the selling what? A company. So which company sold the goods to the other? Which company sold the goods to the other? I hope you can remember your told is 𝗕𝗏, which sold the goods to 𝗘𝚗. So this is unrealized profit by this company here. Unrealized profit by this. So we just copy this one. So therefore, you can say that this is the unrealized profit by 𝗕𝗏. So how do we compute this one? You have to record the formula. Our formula, we said here, we take the unsold goods and sold goods, and then we multiply that with the gross profit margin. We multiply that with the gross profit margin. Unsold goods times the gross profit margin. So let's do that. So the unreleased the unsold goods, the goods not yet sold, goods not yet sold. I think in our case we are told should be half. Is that the case? Yes, half. This one should be half. Half of what? Half of the goods now which were sold. We know the sales were 300 million. This one. I don't know whether it will work because of that word million. Okay. So, okay, let me just type it manually. 300, like this, half of 300. And then we multiply this with the gross profit margin. I hope you can see in this question here, we are given margin. And the question we did yesterday, we were not given the margin. And I think I showed you how to compute the margin in case margin is not given, but the examiner has given you just gross profit markup. So this is how we compute the unrealized profit. The unsold goods, which is half of 300 times the gross profit margin. So this will give us an unrealized profit of what? Of 30. So which adjustments are required here? Let me just copy this one. So which adjustments are required? One, we said, in preparing the consolidated statement of financial position, this one, in preparing the consolidated statement of financial position, that is a consolidated balance sheet. One, we rest this from the group inventory, and actually that's what we did. Group inventory, we rest that from the group inventory. Then, when preparing the consolidated income statement, this unrealized profit, always, you have to recall this. This one is added to the group cost of sales. If you can be able to recall the adjustments we discussed, that's what we say. So therefore, this one will be, those are the key consolidation adjustments. Though also we said that this one should also be deducted from the retained earnings, of this company, that is 𝗕𝗏. But remember, you say that this is one of the item basically which in an exam setup, you may decide to ignore. So these are the key consolidation adjustments. Erase it from the group inventory and then add it to the group cost of sales. Okay, so we are done with that one. Let's move to the other point. To the other point. We are done with this one. So in point number 5, we are told included in the trade receivables of 𝗕𝗏 was shillings 80 million due from 𝗓𝗍 Limited, and then in the books of 𝗓𝗍 Limited, the amount due to 𝗕𝗏 was shown as 60 million. Because 𝗓𝗍 Limited had remitted shillings 20 million, but 𝗕𝗏 Limited had not recorded the remittance. So basically, this is all about an amount of intercompany debt, which is not the same. So therefore, which adjustments are required as far as that is concerned? So let's have that as working for intercompany debt. And actually this is similar to the other question we did yesterday. So amount of intercompany debt. Amount of intercompany debt. So as far as this amount of intercompany debt is concerned, maybe we can just first of all summarize it. We are told that the company which is called 𝗕𝗏, or we are told included in the receivables of 𝗕𝗏. So if this amount is included in the receivables of 𝗕𝗏, it means that 𝗕𝗏 Limited was expecting 80 million from 𝗓𝗊. So if I owe you money, then to you that is the receivables. So it means that you're expecting money from me. So therefore, the amount which was included in the receivables of 𝗕𝗏, let's have the two companies here. We have 𝗕𝗏. Let me cut this one. And actually, we are told now trade receivables of this company included what? Included 80 million. Included 80 million. So it basically means that the payables of this other company, the payables of this other company, which is 𝗓𝗊, payables of 𝗓𝗊. Let me just copy this one. I copy this one. And then I have it here. So basically, we have said that 𝗕𝗏 Limited was expecting money from this one. So it therefore means that the trade payables of this company, equally included similar amount, or should have, or the amount included in the payables of 𝗓𝗊 should be the same. Okay, that is 80 million. 80 million. 80 million. But is that the case? We are told that is not the case, because we are told the amount of intercompany debt is not the same. So let's go back to this point. We are told in the books of 𝗓𝗊, the amount due to 𝗕𝗏 was shown as 60. So basically, we are told in the books of 𝗓𝗊, the amount due to 𝗕𝗏 was 60. So the amount which this company, that is 𝗓𝗊, owed okay. Yes, so the amount this particular company owed to the parent, we are told it was 60. It was 60. It was 60. So automatically, even without going to the other point, we should be able to know here that there was a cash in transit, which is the difference. And the cash in transit in our case should automatically be 20 million, even without going to the other statement. So therefore, how are we going to adjust these consolidation adjustment? One, we are going to raise 80 million from the group receivables. We are going to raise 60 million from the group payables, and then the cash in transit of 20 will be added to the group cash and bank balance. So that is the adjustment which is required in relation to that amount of intercompany debt, which is not the same. So then we move to point number 7. You are told impairment test carried out at the end of the year revealed that neither the goodwill on acquisition nor the investment in associate had impaired. Okay, no working there. And then you're told none of the group companies paid what? Dividends. So no workings which are required there. So and I think we can go straight to preparing this one. Any other working which is required, you're going to do it later on. But let's first of all prepare this one. I need to copy this one. Control-C. And then I bring it here. Control-V. Yes, I can do with this one with the numbering. I also make this one to be a little bit, it's already bold. And then I can also make it a little bit clear here, like this. Yes. So I need to have just a single column here. And my figures will be in million of shillings. I copy this one. I bring it here. I paste by pressing Control-V. Okay. So now remember, for you to be able to know how to prepare this one, you must always have the group structure. Group structure is one to guide you. So from our group structure, we know that 𝗕𝗏 is the parent. This is the parent. This is a subsidiary. And actually, we know this subsidiary from our group structure it was acquired 9 months to the end of the year. And therefore, you have said we are going to take into account the revenue and expenses of this company for how many months? For 9 months. For 9 what? Months. And then this is an associate. Are we going to combine to consolidate the revenue and expenses of the parent with that of the associate? No. We said when accounting for the associate, we use the equity method, which requires that the only item we include in the consolidated statement of profit or loss as far as the associate or joint arrangement is concerned is the parent company share of the associate or joint venture profit after tax. So therefore, in this case, we will not include the revenue and expenses of 2.2 in the consolidated statement of profit or loss. So therefore, what I need to do is first of all to copy all this. I need to copy all this. I say Control C. I highlight everything. I need to copy all that, and then I have that here. I Control V like that. And then in this case, what do I need to do? I need to consolidate this. And in this case, we said first of all consolidate, and then you go through those items as you make the adjustment to whatever need to be adjusted. So I will take the revenue and expenses of the parent plus that of 𝗓𝗍. But for 𝗓𝗍, basically in this case, I will take only for 9 months. So therefore, here, I'll take this one. I'll take the revenue for parent plus, I hope you can see my formula up here. This one. And for this one, I'll only take for 9 months. For 9 months, I will multiply this with the 9 all over 12. And in this case, in fact, I can just use the closing and opening bracket so that my work will be accurate like that. Yes, I hope you can see what I've done here. I've taken the revenue for the parent for the whole year, but this one, and that's why we have the opening and closing bracket, I've only taken that one for 9 months. So then what do I need to do? I enter. And actually now we can confirm before now, because we are going to use that formula down, we can confirm, is that correct? Is that correct? So maybe we can just confirm this one. So we take this and basically we multiply that with the 9 all over 12. So it will give us 1950. So we can confirm we take this one plus this. Okay, not that one, plus this one. We see whether it will give us whatever you have in our consolidated statement of profit or loss. Yes, 6140. So basically what I need to do, I don't have to repeat all that for the other items. I just need to drag my formula. I just need to drag my formula down. I just need to drag my formula like that. So what now we will be able to have here is the revenue, or actually all the other items, including the cost of sales, the expenses we have taken for the parent company for the whole year, and then for this subsidiary only for 9 months. Maybe you can just confirm for another item down here. For example, this one, or we can just apply our formula down here. This one, because we already have a formula here, maybe you can drag it downward. And also we drag this. We already have a formula here. Let's drag it across. We see whether we have these figures. 6140. Yes, and I hope you can see these are the revenue and expenses for 𝗓𝗍 for 9 months. So we can just confirm this, that is 780, 450, 800, 55, 125. And we check whether those are the figures we have here. Yes, you can see those are the figures we have here. Yes, now before we make the adjustment, maybe I can align whatever need to be aligned here. We need to align the cost of sales. We also need to align the administrative. We align the finance. We align this one. We align that one. Yes, so I think we can align those items. And then there is somewhere I need to insert an additional column here. So basically, remember, we have an associate here, which is 2.2. We need to include the parent company share of associate profit after tax. And actually that one should be included below the profit from operation. So maybe I can add, or maybe I create an extra column here. I just cut this one. To cut, we said is to Control X, and then I paste it from here so that I have a row there. And then I do what? I paste it like that. Yes. So what I want to add here is what is called the group share. The group share of associate, which is basically 2 profit after tax. 2 limited profit after tax. So how do I compute this one? So to compute this one, I'll just come and take the profit after tax of 2. Profit after tax of 2 is basically what we have here. Also recall 2 was acquired 3 months to the end of the year here. So what we need to do, we first of all compute the profit for 3 months, because the parent company will only be entitled to share profit for 3 months. We multiply that with 3 all over 12. And then we get the parent company share of this. The parent company share of this will be equal to 30%. Is it 30% or 40%? Should be 40%. It should be 40%. Because the parent company acquired 40%, it should be 40%. Yes, 40%. 40% of this one. Yes, so that now will give us 20. So which is now the group share of 2 limited profit after tax. Now, then what do I need to do? I know there are a number of items which need to be adjusted here. For example, the revenue here, I'll come and click this revenue, and then I make the necessary adjustments. So revenue, we said this one will have to be adjusted with the amount of intra-group trading. So this one, remember the amount of intra-group trading is this 300. So I will come to this and I will less 300. I can type it manually like this. I can type it manually, and then I do what? I enter. That is the only adjustments to be made to that one. I hope you can see what we have done there. We have deducted 300, which is the amount of intra-group trading. So does the cost of sales require adjustment? Yes. The cost of sales also require adjustment. I'll make my adjustment up here. So the first item we need to adjust to this one is to less this particular amount of intra-group trading, this one, so which is still 300. There is also another adjustment whereby we need to add. Remember, we have unleased profit, this one. We have said we added to the group cost of sales. We add 300. Not 300, sorry. We add 30. This one, unleased profit. So we add 30. I hope you can see my workings up here. Do we have any other adjustments to be made to the cost of sales? No. I just enter. Yes. I enter. And the gross profit, I think we need to recompute these afresh as the difference between these two. Yes, that will give us 1790. What about the distribution cost? The distribution cost, this one do not have any adjustments. Actually, in the question for group accounts, if you can be able to recall, always these are free mark. The distribution costs do not have any adjustment. So what about the administrative? The administrative, this one, is usually adjusted with the, or actually what we do here is that we add any impairment loss, impairment loss on goodwill. But I hope you can be able to recall, we were told that the goodwill on acquisition was not impaired. So if it was not impaired, it means that this item will not have any adjustment. And then I can recompute this one afresh. So I get out of some here, so which will be 540. And then from there, I think this one do not have any adjustment, is what we have just computed. And then the investment income. Investment income, which we have taken the investment income of this one, and this one we have taken only for 9 months. Is okay. So the only thing you need to check, and that's why we were given this last point here, that none of the group companies had paid dividends. So there are some instances whereby you may be told that maybe the subsidiary had paid some dividends. If, for example, this company had paid some dividends, automatically 80% of those dividends were paid to the parent. So the parent company then go ahead and account for that as an investment income. If this company had paid dividends, 40% of those dividends are paid to the parent. The parent company accounts for that as an investment income. So therefore, in case you are told either the parent, not the parent, the subsidiary or the associate had paid dividends, and which were then accounted for by the parent company as an investment income, that is an investment income generated within the group. And actually we said, when preparing the consolidated statement of profit or loss, here we don't include, or in other terms, we exclude. We do what? We exclude any investment income. We exclude investment income, or actually we can just refer to this as intragroup investment income. Intragroup investment income is basically investment income generated within the group. E.g., a dividend received by the parent company from who? From the subsidiary or associate. So that one should totally be excluded here. So, but in our case, we are told none of the company paid dividends. So meaning that this is an investment income outside the group. So no adjustment for that. Finance cost, no adjustment. Profit before tax, this one we can adjust it by getting out of sum here for 90. So the other free mark in all questions for group account is income tax. Income tax, this one do not have any adjustment, just like what you have said for distribution. Maybe I can just note it here that this one do not have any adjustment. No adjustment here. No single time you will come across a question for group accounts whereby the distribution cost is to be adjusted. No single time. So this one is always a free mark, and also the income tax, this one, and also the income tax. So therefore, those are basically free marks. So then finally, we can recompute these afresh. And actually that will give us 190. Yes. So that is it. That what was required here. So basically we are done with that one. So we can proceed and prepare this one, the consolidated statement of profit or loss. We just copy this one and then we bring it up here. So we Control V. We can do away with the numbering here. Can also shade this one. Yes, to make it a little bit clear. Yes. So now a consolidated statement of financial position. How do we prepare this one? We prepare this one by combining, or in other terms, amalgamating assets and liabilities of the parent and that of the subsidiary. So we don't include the assets and liabilities of the associate. If you can be able to recall the question we did yesterday, we said, as far as the associate or joint venture is concerned, what we include here in the consolidated statement of financial position is something called the investment in associates. So we don't include the assets and liabilities of the associate or joint venture. So I need to copy all this. I say Control C. I bring it here. Control V, like that. I also need to have a single column here, and my figures are in million of shillings. I can just copy that one. I copy this one. And I hope you can see how I'm making my work very easy in terms of avoiding a lot of typing. So wherever you can be able to copy, you just copy it. So by doing that, you'll be able to finish the question within a very short period of time, because you are making your work to be a little bit to be very, very simple. So I Control V. Yes. So this one is prepared by combining assets and liabilities of the parent and that of the subsidiary. I need to generate my formula here using the first item of PP. So I will take the assets of the parent plus those of the subsidiary. Now, what is also important here is that when preparing the consolidated statement of financial position, I hope you can remember the parent company had 80% shareholding in 𝗖. So we take the full amount of the assets and liabilities of the subsidiary, even if the parent company do not have 100% shareholding. Number two, even if the subsidiary is acquired 1 month to the end of the year, 2 months to the end of the year, 3 months to the end of the year, never make a mistake of apportioning the assets and liabilities on time basis, like what you have done to the items of revenue and expenses, simply because a statement of financial position is prepared as at the end of the year. So therefore, despite our subsidiary having been acquired 9 months to the end of the year, we will not apportion the assets and liabilities of 𝗓 on time basis. Take the full amount. Sasa? Yes. So in this case, I've generated my formula. I've taken the PP of the parent and that of the subsidiary. So because I already have the formula, I don't need to repeat this for the other items. So what I need to do, I need to drag all this up to where we have the total assets, like that. Yes, like that. And then I can in fact get the okay, let me first of all do the adjustment. We do the adjustment here. So we check which items need to be adjusted. Like PP usually we say that this one is usually adjusted with something called the fair value adjustment. So if the subsidiary company devalued the asset and there was a revaluation gain, I think we looked on how we adjust that one. So we said that revaluation gain added to the group PP, and also you need to compute the depreciation other charge. Recall, in this point number 1, our subsidiary, which is 𝗓, revalued the asset, but we were told the fair value was equal to the carrying amount. There was no revaluation gain or loss. Equally here, we don't have any depreciation overcharge or other charge. No adjustments as far as this is concerned. Then below that, what do we have? We have investment. Now, this investment automatically, we said, this, the examiner will not tell you, but this includes the purchase consideration paid in acquiring shares of the subsidiary and also purchase consideration paid in acquiring shares of the associate. So therefore, this 1600, the number of items we are going to less here, 1, we're going to less the amount which was paid in acquiring 80% shareholding in the subsidiary, which is given in note 1 here. The purchase consideration of which was paid is this one, 1100. So which is part of this figure. So we less it there. We said that one should not be included here. Instead, what we need to include here is the goodwill on acquisition. And actually, we're going to compute the goodwill on acquisition and we recognize it here as an asset. Number 2, we also need to less this purchase consideration which was paid by the parent in acquiring 40% shareholding in 𝗂𝗂. So it is part of that 1600. So we less 500 like that. Like that. Yes. Can you see by the end of the day that figure is coming to 0? Yes, because now this investment which we have here, it basically include now 1100 paid in acquiring shares of the subsidiary and 500 in acquiring shares of what? Of the associate. So that one will be 0. And then by the end of the day, what we need to compute here, so what I need also here is to create 2 additional columns. 2 additional columns. I can do that by cutting this. I highlight everything. I say Control X. I want to cut that. I want to create 2 additional columns here. So this and this, I'll paste it from here. I say Control V. So you can see it's moving downward. And basically here I've created 2 additional columns, not columns, rather rows. This is for including what? I will compute the goodwill, or basically we will compute the goodwill on acquisition, the goodwill on acquisition of our subsidiary, which is 𝗓 Limited. And actually we recognize it here as an asset. And then in addition to the other company, which is 𝗂𝗂, we are going to compute something called investment. Investment in 𝗂𝗂 Limited. Investment in 𝗂𝗂 Limited. And actually, we also recognize it here. So I think we will compute this as the last. Let's have this as our last working. So let's move to the other item here, which is inventory. Inventory, do we have any adjustment? Yes, we said the adjustment which is made to this is in relation to unrealized profit. Do we have unrealized profit? Yes. So the unrealized profit in our case was 30. And actually, we said other than adding that to the cost of sales, we also left it from the group inventory. So to this, we left 30. We left 30. We left 30. Yes. And we will get the final figure here as 890. You can see how we have arrived at that figure. We have taken, actually, our formula is appearing up there. B26 plus C26. B is basically here. Is the, remember in terms of how the cells are numbered, always we start with the number of row. Sorry, the number of the column. So this is the column B, and then you have to go to row 26. So row you read from here, this one. So B26 and C26. So we have taken the inventory of the parent plus that of the subsidiary, and then we have deducted and raised profit. Then trade receivables, do we have adjustment for this? Yes, because we have amount of intercompany debt. So we come up there and we say, we're going to raise the amount of intercompany debt. We said from the group receivables, how much amount are we going to raise? 80. 80, this one. 80. So 80, that is what we are going to raise. We enter. What about financial asset? Financial asset, usually this is also another item which do not have any adjustment in the question for group accounts. I've never seen a question for group accounts whereby this item, in case you're given financial asset, I've never seen a question having adjustment for this. Usually, these do not have any adjustment. This one do not have any adjustment. Yes, so that is basically a free mark. What about the cash? Yes, we have adjustment for this. We need to add, okay. So I need to redo this one to undo. Okay, so to this we need to add the cash in transit. The cash in transit was how much? As per this working, the cash in transit was 20 million. So we add 20, and then we do what? We enter. So that basically will give us the final figure, but automatically there is something which you have not computed here. So let me first of all we get this total for current assets, and then for the these total assets will be equal to this plus this investment plus this goodwill on acquisition plus investment in 𝗂𝗂 plus all this. There is a figure which is disappearing here, but I can pick the individual current assets. And I think that one. Yes. So, but remember there are a number of items which you have not computed up there. Investment in associate and also the goodwill. So basically once we have computed those figures and we insert our figures here, our total will automatically be adjusted. Okay. So then let's move to the items of equity. Remember for share capital, share premium, we only include that of the parent. So for the share capital, this one we only include that of the parent. We enter, that will be 25. Okay, I enter. And then share premium, we only include that of the parent. That of the parent company, how much is that? 500, okay. So then the number of items equal in this question, we will not compute this one. The group retained earnings. We say in an exam setup, just ignore this one. So this one, just ignore it. Maybe you can just ignore. Just say ignore. Ignore. Don't compute. Don't bother yourself computing this one. We say this is one of the items which generally is quite involving. I can also create an extra space here by pushing this item downward. I'll cut them by saying Control X, and then I paste them from here, Control V, because there is also another item which we also include here, which is non-controlling interest. Equally, we said that this is also another item which you can do what? Which you just also need to ignore. The computation of this is also quite what? Engaging, quite involving. So we can also ignore that one. So those two items, these two items, NCI, and basically the group retained earnings. So you don't have to compute them. And remember, in this case, what we said is that for you to be able to get all the marks, you don't have to get everything to be correct here. So let's move now to the current, to the liabilities. Remember, for the liabilities, we add those of the parent and those of the subsidiary. So for the liabilities, I'll just pick those of the parent starting from non-current. I need to generate a formula. So plus this one. So I've taken this plus this. I hope you can see my formula up there here. So, and then I do what? I enter. Do I need to repeat that for the other items? No, I just need to apply this formula here. And I drag it down. I drag it down like this. Yes. So now this basically what we have here. Now deferred tax, okay, first of all, a 12% raw note. This one do not have any adjustment. But if you can remember the question we did yesterday, I think we were given something to do with the raw notes or debentures, but we made some adjustment in relation to that because there are some debentures which were acquired by the parent company, the subsidiary. So we said the debentures held by the parent company, the subsidiary, should not be included here. So in this question, are we given such information? No. So deferred tax, anytime you come across a question for group accounts and you're given a component of tax in the balance sheet or in the statement of a financial position, these one equally do not have any adjustment. No single time that this item will be having an adjustment. So therefore, also these are free mark. This is also basically a free mark. A free mark here. A free mark. And also current tax under the current liabilities. Maybe I can also note the same for this one, current tax. So any component of tax in the income statement, in the statement of financial position, do not have any adjustment. So equally, this is also another free mark. So now, but for the current liability, sorry, for the trade payables, that is, we have an adjustment for this because we have amount of intercompany debt. So the amount of intercompany debt which we need to less from the payables, we said in this case will be 60. So to this we less 60. We enter. So I hope you can see this figure we have taken. Payables of the parent plus that of the subsidiary minus 60. Do we have anything else? No, we don't have anything else. So basically here, I think we can get the. Okay, so the total, do we need, no need of getting that. Yes, I think there are two items which we need to compute here. These two items here, and the goodwill on acquisition of 𝗓𝗧, and also the investment in associate, which is 22. So I want us to start by computing the goodwill on acquisition. Basically, this will be a working, and I hope you're together up to that point. In case of any question, type it there, you'll be able to see it. Just fat, Sarah, I hope you're together up to that point. In case of any question, type it in the chat box. I'll be able to see the questions there. Okay, so I want us to compute the goodwill on acquisition. I can have that working here. Basically, in this case, I need to have two columns. Then here, remember we are using which method in computation of goodwill? In computing the goodwill as per the information we were given in note number 2, we are using the partial. And actually we said under the partial goodwill method, we only compute the goodwill of the parent company. So how do we compute this particular goodwill of the parent company? So we start with the purchase consideration. Purchase consideration which was paid by the parent company. And I hope you can be able to recall the amount of purchase consideration which was paid by the parent company in acquiring 80% shareholding in 𝗓𝗧. So that was in note 1 here. So the purchase consideration paid was 11. So then, because now we are using the partial goodwill method, to this we need to less. To less the fair value of net assets acquired. Fair value of net assets which were acquired. And I think you can also be able to recall how we compute this one. We say to compute this one, we take the ordinary share capital of the subsidiary plus all pre-acquisition reserves. I think I can just copy these items which we have here. I copy this one, Control-C, Control-V. I need to bring that down here, Control-V. So For share capital, I take the share capital of the subsidiary, which is 500. This one I enter. For the share premium, remember you said that in case you're given the share premium in the balance sheet of the subsidiary, unless otherwise, it is always treated as a pre-acquisition. So this subsidiary or the subsidiary company had this share premium on the date it was acquired. So it is a pre-acquisition. But now these retained earnings, the retained earnings, this one is not at the date of acquisition because we know these are retained earnings or the retained profit at the end of the year. Now, anytime you come across a question for group accounts and a subsidiary company was acquired during the current year, like in our case, I hope you can remember this subsidiary was acquired during the current year, 9 months to the end of the year, no single time the examiner will give you it retained earnings on the date of acquisition. What you do, you compute that one because whatever you're given here, these retained earnings, which we have here, I've said these are retained earnings at the end. So therefore, these are retained earnings at the end of the year here. It is the retained earnings at the end. So, but now, let me just cut this one. I paste it here. So, but now we also given the profit after tax, or basically the profit for the year for the subsidiary, this one. We have the profit for the year here. The profit for the year is 400. So the profit for the year is what? Is 400. So the first thing we need to do is basically to determine what is the retained earnings of this company at the start. So how do we determine the retained earnings at the start of the year? To determine the retained earnings of this company at the start, we take these retained earnings at the end, this one, minus the profit for the year. So we take 800 minus 400, that will give us 400. So 400 is the retained earnings of our subsidiary when the year was starting. What are we interested with? We're interested with the retained earnings on this date, the date of acquisition. This one. How do we get the retained earnings on this date? To get the retained earnings on the date of acquisition, we take the retained earnings at the start, this one, 400, and then to this we add what? Remember, this subsidiary was acquired 9 months to the end of the year. It was acquired 9 months to the end of the year. So meaning that it was acquired 3 months after the year started. So therefore, for us to be able to get the retained earnings or its retained earnings on the date it was acquired, we take its retained earnings at the start, and then we add the profit which was generated by 𝗓𝗍 3 months before it was acquired during the current year, because the profit it's generated for the whole year is 400, but in our case, we're interested with the profit it's generated 3 months before it was acquired. So therefore, you multiply that with 3 divided by 12. So that now will give us its retained earnings as per the date it was acquired. As per the date it was acquired. I hope you can see we have taken the retained earnings at the start, and then we have added a profit of 3 months, which it reported before it was acquired. So that will give us what? That will give us 500. So this 500 is basically the retained earnings of 𝗓𝗍 on the date it was acquired. And that is now what we are interested with here. The retained profit on the date it was acquired. And basically that is the figure we have computed up here, which is 500. So we bring it down here. The other thing we said we need to check is whether this subsidiary revalued the assets on the date of acquisition. Was there any revaluation of assets? If there was any, was there a revaluation gain? I hope you can remember, as per note number 1, this company, we were told it revalued the asset, but we were told that the fair value was the same with the carrying amount. It basically means that there was no revaluation gain or loss. And therefore, this is how we determine the net asset of our subsidiary on the date it was acquired, which now will be 1200. 1200 here. And because we are using the partial goodwill method, we take now the net asset acquired by the parent. The net asset acquired by the parent will be this one, 12 times 80%. The parent company acquired 80% of the shares. It also means that the parent company acquired net asset equal to 80%. So 80%, which will be 960. So basically now, let me make this one to be a negative by multiplying this with negative 1, like that one. Yes, like that. Yes, because I need to less that from the figure which is up there. So this one will be equal to this minus this. Okay, so let me type plus, because if I type negative, it will be negative and negative, which will become a positive. So that means that the goodwill on acquisition, therefore, is what? Is 140. So this, also remember, this goodwill is not impaired. I hope you can remember there is some information we are given, I think in note number 7 here, that this goodwill was not what? Impaired. So there was no any impairment loss. And therefore, this is therefore the goodwill which we recognize in the consolidated statement of financial position as a non-current asset. So I need to bring that goodwill here. The goodwill on acquisition of 𝗓𝗍, which you have computed here as a figure of 140. I do what? I enter. That figure will move up there. The figure of 140. So the last item I need to compute is this one: investment in 𝗂𝗂, investment in 𝗂𝗂. 𝗂𝗂, remember, is the associate. Investment in 𝗂𝗂, let me have that working here. So how do we compute this investment in 𝗂𝗂? Investment in 𝗂𝗂, I need to have just a single, okay. Let me copy this, Control-C, Control-V. So we said we compute this one by taking something called the cost of investment. Cost of investment is basically the purchase consideration which was paid by the parent company in acquiring shares of the associate. And I think this figure we had it somewhere. This one in note number 3, it was 500 million. 500 million. 500 million. And then now to this, what do we add? We add something called the group share. The group share of associate post acquisition retained earnings. Post acquisition retained what? Retained earnings. And basically, anytime the associate, or actually a joint arrangement, was acquired during the current year, so the amount which we have included within the consolidated income statement, this group share of 𝗂𝗂 limited profit after tax, that's now what we include down there, in case our associate was acquired during the current what? Year. So that's what we include down here. And then to this, we said we less what? We less any impairment loss. Any impairment loss. Any impairment what? Impairment loss. And I hope you can remember equally there is some information we were given here in note 7. Impairment test carried out on 31st of March 2023 revealed that neither the goodwill on acquisition nor the investment in associate had impaired. So the investment in associate had not impaired. But in case there was any impairment loss, you come and you less it down here. You come and you less it down there. So in our case, it had not impaired. So we get the total amount here, which will basically be 520. 520, yes, and that's now also what we need to recognize here as a non-current asset here. So this will be equal to whatever you have computed down here as 5 what? As 520. As 5 what? 520. Yes. So basically in our case, we are done. Though remember, there is something I've said. There are 2 items here which you have not computed: the group retained earnings and also the non-controlling interest. We have said that these are some of the items which are quite involving. So therefore, in an exam setup, you may decide to ignore, not to compute those 2 items, because by doing that, then you'll have scored like all the marks, provided you can be able to deal with the key consolidation adjustment. So therefore, that is it. That's what was required as far as that question is concerned.